This is NISM certification exam 5B, and we are talking about mutual fund foundation here. Now we are discussing about a topic called factors to evaluate savings and investment product. In factors for savings and investment product, we are going to discuss element called taxation. Taxation means kar, or the taxes which we pay to the government of India. Why do we pay taxes? Government of India says that if you make some income in the country, then part away with that income in some proportion, say 10%, 20%, or 30%, depending upon how much is your total income. And that money which you part away from yourself, you give it to the government as taxes, and the government uses that for the well-being of the whole country, development, security, for military expenses, for building roads, and etc., etc., and etc. So that comes to you in the form of benefit. That's why the taxation is charged. So from investment point of view, taxation has two elements. Element A is taxability of income. Element B is tax deduction. Let us understand element A first. What is the purpose of investment which we do? The investments which we do, the purpose of that investment is return. Return means income. And on this income, there is a tax which is deducted. So taxability of income is whatever the returns which you have generated from your investment, you have to pay some tax on it. Because you are paying some tax on your income, your your return reduces because of the effect of the tax on it. That's why this negative sign is there. It reduces your income. Whereas tax deduction is something which I will explain it to you little later. It says that if there is a tax deduction, it increases your return. And this is very surprising that government taxation is causing you to increase your return. How can that be possible? But yes, that is possible, and we will discuss that. However, a plus sign is put here which says that it increases your returns. So we will understand this step by step. Let us look at taxability of income as the first factor. In this, the first thing which we are discussing is income received from investment. Suppose you have invested some money, and in a financial year FY, you have made 100 rupees as your income. Now on this income, there is a tax rate is there, is applied. Tax are charged in the form of percentage on your income. It is say 10%, 20%, 30%, 15%. These are the different tax rates which are there, which is charged on your income. So if a 10% tax rate is applicable on your this income, then 10 rupees is deducted as tax, and your what you finally receive is 90 rupees. This is your net gain and not 100 rupees. So what is 100 rupees? 100 rupees was the gross money which your investment earned, but in your pocket 90 rupees will come because 10 rupees will go to the government of India, will go out of your pocket to the government of India. This is the reason why it is called as net income. I hope you have understood this point. This is your gain, or this is your net gain, or your money in your pocket. Now, when we look at taxation, there are certain products which offer you low tax rate. And when does that happen? When does this product offer you low tax rate? It is when you hold them for a longer period of time. There is something called as short-term capital gains tax and long-term capital gains tax. We will discuss them little later. There are different rates for that. If you hold an investment for less than a year, you have to pay some rate. If you hold an investment for more than a year, you have to pay another different. You have to pay a different rate, not another, a different rate. So there is a differential rate, or there is a difference in the rates of the taxation depending upon how you hold the investment, depending upon what is the period of holding the investment. This was just as a precursor for our chapter, which we will discuss later under the heading taxation in our future videos. Now let's discuss another important element which increases our return, which is called as tax deduction. When we talk about tax deduction, we are saying that the government of India says to you that if you invest money in certain products as specialized or as specified in IT Act every year, then what we will do is that from your total income which you have earned in a financial year, we will allow that amount of investment as a deduction. एक सब्सट्रैक्ट कर देंगे आपकी टोटल इनकम से दैट अमाउंट. That is why that word deduction comes in. We will deduct that amount from your income. So what happens is, suppose you had made 8 lakh rupees in a fiscal year and you did a tax deduction, you did investments in something called as ELSS or in form of insurance product because of 1 lakh rupees. Because of this investment in these products which are mentioned in IT Act, your 1 lakh rupees is deducted from 8 lakh rupees. You pay tax only on 7 lakh rupees. So instead of paying tax on 8 lakh rupees, you are paying tax on 7 lakh rupees. Hence, your tax amount or tax liability is reduced. Now let us see how does this tax liability increases our return from our investments. This we will now see it in this working. Suppose this tax deduction amount is invested. Obviously, this is invested in ELSS, or you buy an insurance policy. Now, or you invest in certain bonds or other things, whichever the government says as per the IT Act, and it generates a 20% return. So, on 1 lakh rupees which you invested, which was allowed as a deduction, you generated 20,000 of return, which is 20%. Now, by saving 1 lakh rupees and not paying tax on it at 10%, this 10% rate is the same rate which we have mentioned in the above example, the same rate we have used here. You are saving 10,000 rupees on not paying the tax. This is the tax saving. Why and how? Because you have invested, because you are not paying tax on 1 lakh rupees of your income. And how much would that tax would have been calculated at 10%? It would have been 10,000 rupees. So this 10,000 rupees is the net savings which you are having because of tax deduction as applicable to you. So your total effective return becomes 30,000, because on 20,000 rupees, this 10,000 you add, this is not gone out of your pocket, it becomes 30%. So your effective return by following those products which are applicable in tax deduction, you have increased your income. And that is why we say it adds to your effective income by following tax deduction option. Now, hence the tax deduction increases your return. This is what we have proved above. Now, there is a saying or a wisdom which I want to share with you is, never look at any of these products, never look at any of these factors in isolation. What are these factors? We are talking about returns, we are talking about convenience, we are talking about ticket size, we are talking about risk of capital, of return, we are talking about taxability. Never look at these factors in isolation. Look at all these factors together, and also look at your goals and situations, as we have discussed in the last example about a young couple and an old couple whose goals and their situations of their economic situations in their life are very different. So consider these factors with the goals and situations before deciding what will be an appropriate product for your consumer, your customer, or your you as an advisor, what you should advise them. So this is all for this session. In the next session, we will talk about different asset classes. We will first understand what an asset class is and then see what are the different asset classes. Till then, thank you.